On November 15, 2024, China took an extremely critical step for the global financial system. Without making a public announcement and through a coordinated process, approximately $3 trillion worth of U.S. assets were removed from its portfolio. This development represents a turning point that must be carefully analyzed, especially by anyone holding dollar-denominated assets. What I am about to explain is not an attempt to create speculation or sensationalism. It is also not a fear-based narrative. These processes are already taking place and can be observed through data. However, since these developments have not been sufficiently covered by mainstream media, they have not yet entered the radar of the broader public. While households are occupied with inflation, interest rates, and the rising cost of living, a much larger financial realignment process has begun on a global scale. China's move can be considered one of the most comprehensive challenges to the reserve currency system in modern economic history, and at the center of this process stands the US dollar. To understand what exactly happened on November 15th, it is necessary to step away from the political agenda and daily news cycle and look instead at how international finance actually operates. Major shifts in the global financial system rarely occur in public view. They take place through central banks, sovereign wealth funds, and international settlement mechanisms. It is precisely in this area that a significant fracture has occurred. The People's Bank of China began selling U.S. Treasury bonds simultaneously and systematically. These sales were not a limited portfolio adjustment or a short-term risk reduction maneuver. We are talking about a volume of approximately $3 trillion. This amount is larger than the annual economic output of many developed countries. To put this into perspective, this figure is close to the entire economy of the United Kingdom, larger than India's annual GDP, and comparable to the combined market capitalization of the world's largest technology companies, Apple, Microsoft, and Google. Moreover, this process was not carried out through a classic official announcement, but rather through intermediaries, proxy structures, sovereign wealth funds, and international portfolio channels. This process can be identified because global capital flows are not entirely invisible. Custodial accounts of the U.S. Federal Reserve, the Treasury Department's International Capital (TIC) data, and central bank balance sheets are published regularly. When these data are examined, it becomes clear that China has been systematically reducing its dollar-based reserves for a long time. The critical question here is this: why should China's sale of dollars and treasury bonds matter to individual investors, workers, or retirees? The reason is that this process is not merely a portfolio preference, but a strategic step toward reshaping the global reserve currency order. This transformation has the potential to directly affect the real value of savings, interest rates, pension systems, and basic living costs. At this point, it is necessary to correctly understand the background of the process. For roughly half a century, the US dollar has held the status of the world's reserve currency. This means that countries use the dollar instead of their own currencies in international trade. From energy markets to industrial goods, the dollar has been accepted as the global medium of exchange. This structure was institutionalized in 1971 when the United States abandoned the gold standard and through the oil agreement with Saudi Arabia. Pricing oil in dollars created constant and global demand for the currency, giving the U.S. a financing advantage unmatched by other nations. However, the sustainability of this system is entirely based on trust. And over the past 20 years, that trust has gradually eroded. Over the past 2 decades, the United States has created trillions of dollars to finance successive wars, financial crises, bailout packages, and expansionary fiscal policies. During this period, the supply of dollars expanded rapidly, while the long-term consequences of this expansion were largely ignored. At the same time, the dollar ceased to be merely a medium of exchange and became a geopolitical pressure tool. By leveraging international payment systems and its reserve currency advantage, the U.S. excluded certain countries from global trade, froze assets, and restricted financial access. This severely damaged the perception of the dollar as a neutral and universal reserve currency. China's approach at this stage is particularly noteworthy. China did not view these developments as short-term fluctuations. On the contrary, it evaluated them as long-term and structural risks. Over the past 15 years, China has strengthened its financial infrastructure, developed alternative payment systems, diversified its reserves, and steadily increased its gold holdings. For this reason, the $3 trillion exit is not simply a bond sale, it is part of a broader strategy. The objective is to gradually move away from a dollar-centered system and accelerate the transition toward a multipolar reserve currency order. In this new order, China aims to be not merely a participant, but one of the central powers. This strategy is not being pursued alone. Over the past decade, China has deepened its economic and financial ties, especially with developing countries. The BRICS nations form the institutional framework of this process. Brazil, Russia, India, China, and South Africa represent more than 40% of the world's population and an increasingly large share of global economic output. What these countries share is the goal of reducing dependence on the dollar-centered financial system. The decision to expand BRICS in August 2023 demonstrated that this objective is no longer theoretical, but implementation-oriented. The invitation of countries such as Saudi Arabia, the United Arab Emirates, Egypt, Iran, and Ethiopia is of particular importance for energy markets. Special attention must be paid to Saudi Arabia. The fact that Saudi Arabia, the cornerstone of the petrodollar system, has begun openly discussing non-dollar trade systems signals a serious fracture in the existing reserve currency order. This is not a minor policy shift, it is a questioning of a structure that has existed for half a century. One of the tools China has used in this process is bilateral currency agreements. China conducts a significant portion of its trade with Russia in rubles and yuan. Agreements with Brazil allow the two countries to use local currencies in trade. In addition, China has established currency swap lines with dozens of countries, creating an infrastructure capable of entirely bypassing the dollar. However, the most critical element of China's strategy is gold. While the U.S. expanded its money supply and increased its debt stock, China quietly but decisively increased its gold reserves. According to official statements, China's gold reserves stand at around 2,000 tons. However, independent analyses and trade data suggest that the actual figure may be much higher. Some estimates indicate that China could be holding over 20,000 tons of gold. Gold's importance at this point is substantial. Throughout history, gold has been a reliable store of value. It cannot be printed, cannot be multiplied by political decision, and is not inherently fiat. If China were to decide to partially back its currency with gold, the yuan could become a serious alternative in the global system. Consider the following scenario. China announces that the yuan is convertible into gold at a certain ratio. In such a case, a choice would have to be made between a currency based solely on debt and trust and a currency supported by a physical asset. In such an environment, a shift by central banks and large funds would be inevitable. For this reason, China's exit from the dollar can be interpreted as a positioning phase before declaring a new system. The exit is taking place while the dollar is still strong and liquid. Because after a major rupture, executing an exit of this magnitude would no longer be possible. At this point, the risk of a chain reaction emerges. Once the seriousness of China's move is recognized, other central banks may begin reassessing their reserves. Central banks around the world collectively hold trillions of dollars in U.S. Treasury bonds. If a significant portion of these assets were to be sold, the dollar's reserve currency status would be seriously questioned. The consequences of the dollar losing this status are not merely theoretical. The first and most immediate impact would be seen in interest rates. Today, the U.S. can borrow at low cost because there is global demand for Treasury bonds. When that demand weakens or reverses, borrowing costs rise rapidly. This would push up the entire interest rate structure, from mortgage rates to consumer loans, from credit cards to corporate financing. The housing market would come under pressure, investment would slow, and economic growth would face serious constraints. The second major impact would appear on the inflation front. As global demand declines and dollars held abroad return to the U.S., the effective money supply increases. More dollars chasing the same amount of goods and services leads to sharp price increases. This is a classic reverse capital flow problem. The third impact would be on living standards. The U.S. has long maintained a consumption-driven economic model. The dollar's reserve currency status made this model possible. When that advantage weakens, import costs rise and purchasing power declines in real terms. This represents a long-term erosion of prosperity. At this point, another issue that must be emphasized is the state of U.S. public finances. The total federal debt of the United States has exceeded $35 trillion. Moreover, this debt stock is not merely stable, it continues to grow by trillions each year. The sustainability of this debt relies heavily on the dollar's reserve currency advantage. Thanks to this status, the U.S. can roll over its debt at low interest rates and expand the money supply when necessary to manage short-term pressures. However, if this status weakens, the cost of servicing the debt rises dramatically. At that point, printing money deepens the problem rather than solving it, because it directly fuels inflationary pressure. In such a scenario, the U.S. government would face extremely difficult choices. It could be forced to make sharp cuts between Social Security spending, healthcare systems, defense budgets, and public investment. The alternative scenario is a failure to roll over debt and a deepening confidence crisis. Both options pose serious risk to economic and social stability. These developments may seem extreme or unlikely. However, history has repeatedly shown that reserve currency status is not permanent. At the beginning of the 20th century, the British pound was the center of global trade, but rising debt, war expenditures, and economic pressures forced it to cede this role to the dollar. This transition did not take as long as expected and was far more painful than anticipated. What we are witnessing today can be considered a modern version of this historical cycle. Such transformations usually begin slowly, then accelerate after a certain point. The steps China has taken over the past 15 years, and particularly the $3 trillion exit, may indicate that this acceleration phase has begun. It is important to make a clear distinction here. These developments do not mean that the U.S. economy will collapse overnight. However, current trends show that the dollar's relative weight in the global financial system is declining. This implies more expensive borrowing, higher inflation risk, and lower growth potential. So, how might the U.S. respond? Theoretically, there are several options. The first is to significantly raise interest rates to make the dollar attractive again, but this would cause severe contraction across broad segments of the economy, from housing markets to the real sector. The second option is to implement capital controls, restricting capital outflows and forcibly maintaining dollar demand. However, such a move would cause a serious loss of confidence in global markets and deepen the crisis. The third option is to seek diplomatic and economic compromise with China and other rising powers. But at this point, the balance of power has shifted. China appears as a well-prepared actor, while the U.S. looks more like a party trying to preserve the existing system. This picture matters not only at the state level, but also for individuals, companies, and investors. Because changes in the reserve currency system directly affect the real value of financial assets. The balance between interest rates, inflation, and exchange rates is being reshaped. One area requiring particular attention is inflation expectations. Inflation is not merely about current price increases, it is shaped by expectations about the future. If market participants lose confidence in the dollar's long-term value, those expectations are quickly reflected in prices. Another key area is global trade balances. The U.S. has long-run persistent trade deficits. These deficits were sustainable due to the dollar's reserve currency status. When this advantage weakens, import costs rise and trade balances come under increased pressure. This in turn forces changes in production and employment policies. Greater domestic production, higher costs, and lower consumption levels may become the new economic equilibrium. All of these developments cannot be explained by a single move from China alone. However, China's actions function as a catalyst, accelerating and revealing the process. The global financial system has been searching for transformation for a long time. Now that transformation can be observed more clearly through concrete data. The most important point to emphasize here is this. The process described is not an abrupt collapse scenario. Global financial systems rarely disintegrate overnight. Instead, a long-term and gradual rebalancing process takes place. China's $3 trillion asset exit should be interpreted as part of this process. In such transformations, the greatest risk is being unprepared. When market dynamics change, actors operating under old assumptions find themselves at a disadvantage. For decades, the assumption that the dollar is safe under all conditions formed a cornerstone of global finance. Today, that assumption is being questioned, not only by China, but also by central banks and major institutional investors worldwide. For individuals, the key point is to view these developments not as a cause for panic, but as a signal. Financial systems operate on signals. Major capital movements begin long before retail investors become aware of them. Therefore, the critical question is not what will happen, but which direction are we moving? This directional shift may point toward a more fragmented global financial structure. Instead of a system revolving around a single reserve currency, we may see increased use of regional currencies, bilateral trade agreements, and alternative payment systems. This does not mean financial stability will disappear, but it does mean higher volatility and greater importance of risk management. The question, what should be done, is often asked. There is no single universal answer. Every individual, company, and country has a different risk profile. However, general principles remain constant. Excessive leverage and dependence on a single asset class or currency create the most fragile positions during such periods. Diversification, liquidity, and long-term thinking are the fundamental defenses in times of uncertainty. It must be emphasized that this narrative does not claim the dollar is finished. The dollar remains at the center of the global system. But there is a crucial difference between being at the center and being unquestionably at the center. What we are witnessing today is that this distinction is becoming increasingly clear. Historically, the erosion of reserve currency status is as much a psychological process as it is an economic one. When confidence weakens, the impact is reflected in prices, interest rates, and investments. That is why the real issue is not today's numbers, but tomorrow's expectations. What this video has presented is not a story of an end, but a story of transition. The global economy has been moving away from familiar balances and searching for a new equilibrium. China's move shows that this search has shifted from theory to practice. What must be done now is to look beyond daily headlines and read the bigger picture. Because economic transformations usually begin quietly, and by the time their effects are widely felt, they have already been priced in. In the coming period, decisions by central banks, reserve compositions, and large capital movements will be more decisive than ever. Therefore, such developments should be evaluated not as isolated news items, but as interconnected pieces of a larger process. The topic covered in this video is less about today's headlines and more about tomorrow's economic realities. And when read correctly, these realities represent not a threat, but an opportunity to prepare. If you've watched this far, I would be very happy if you support the channel by liking the video and subscribing. See you in the next video. Take care. Thank you.